With investing, you want to do your best to try to take emotion out of your investment philosophy. Come up with a strategy and stick with it no matter what's happening. Now, today I'm going to be talking about some common investment behaviors that can lead to mistakes with your portfolio. Number one, loss aversion. So people can have the philosophy that they just want to make sure they don't lose any money. So they'll mistakenly hold on to a stock for many years just so that they don't say that they lost money. So even if it turns into something that they should probably sell, they'll just be saying, I'm just going to wait till it gets back to where I bought it and then sell. Number two is the fear of regret. Mark Twain once said, 20 years from now, you will regret the things that you didn't do instead of the things that you did. The fear of regret philosophy with investing is kind of like FOMO, fear of missing out. So think of Bitcoin. In the beginning stages, they made a lot of money, but when people started to get comfortable with Bitcoin, that's when it started to go down. So you want to make sure that you're not buying high and selling low. That's the whole idea with investing. Make sure that you're not waiting until you're completely comfortable, because sometimes that can be the top of the market. Number three is overconfidence or optimism bias. So basically people can start to believe that what is happening now is going to always happen in the future. There was a study done and 80% people were confident in which direction the market was going to go. 40% of them were right. So the point is, you don't want to overpromise or over-expect what's going to happen within future investment returns, because when you start anticipating 12 to 15 to 20% on your investment returns for the rest of your life, that can lead you to think that you don't need as much now to save for retirement. Four is representativeness. Right, so that's the idea that there are stereotypes. Basically, this is the person looking at your 401k options and saying which one has the best performance over the last 1, 3, and 5 years. The performance in the past really doesn't have much indication of how it's going to do in the future. So we have to remove ourselves from stereotypes like that to make sure that we're being wise and constantly evaluating what's best now moving forward. Number five is framing. People are affected by the way something is presented. So for example, a store had one shirt. They wanted to sell it at $35. They would probably sell it a lot better by saying it's $50, $15 off, rather than just saying it's $35 straight up. People are influenced by the way something is presented. So that's why you see a lot of stores always having sales and whatnot. People feel that they're getting them at a discount, but ultimately that store always wanted to sell it at that price. Number six is hindsight bias. This is a tough one for advisors like me. So a lot of times clients can have hindsight bias, saying that looking in the rear view mirror, I knew this was going to happen. So for example, you could say Apple stock is going to go up, and the client could say, yeah, that sounds great. And then Apple stock goes down, and they could say, I knew Apple stock was going down. So you want to try to avoid hindsight bias, trying to just be realistic with the way you're feeling, make the best decision you can at the moment, and stick to your gut. Number seven, recency bias can be a lot similar to fear of regret or FOMO. So you put a lot of weight into what's happened recently rather than looking at the whole picture. So this is getting on the train before it leaves the station, that type of concept that doesn't always work in the long term. Eighth behavior that I'm going to cover today is status quo bias. All right, so status quo bias. When people are presented with a decision, they tend to just stick with what they're currently doing. We have to learn with investments, with life, with everything, to understand that change happens. We have to learn to adjust, and sticking with status quo isn't necessarily always best, so you have to be comfortable with change. There are a lot more behaviors out there that can affect investing. It is human nature to fall trap to some of these emotional behaviors. I've done it myself, and I probably still do it, but there's a lot more out there. I encourage you guys, again, come up with a big strategy for your investments, understand that markets fluctuate, and try to stick with that strategy through the thick and thin. See you next time.